We're still in chapter 13 here, and what I'm going to do here is I'm going to explain the classification issues of short-term debt and some of those issues that arise when this debt is expected to be refinanced. So let's go ahead and walk through the problem that we've already created. Here's the problem. It might be kind of small there for you to read, but I'm not going to read through this. You can read through it, but basically we've got an issue where we've got some debt and some dates that span between two different fiscal years. So here's the explanation I've drawn out. I've got a lot of colors here, but that's what helps keep this straight for me. So in essence what happened was we've got the year 2012. We have $1.2 million in short-term debt. It's short-term because it's due in 2013, which is the next fiscal year. And so we know logic would tell us that, oh yeah, this $1.2 million should be classified all as current liability. However, we've learned that that's not always the case. Here are the two transactions that have happened subsequent to when we actually released the 2012 financial statements. So 2012 happens, it's the end of the year, it's December, and I've got the pink down here, and on December 31st, this is the last day of the fiscal year, so we're going to release our financial statements that have transactions including up to this date. But it's going to take us a while to actually release these statements. It's a long process to actually finalize year-end figures, so we're not going to release them until, look at, in the next fiscal year, which is 2013. It'll be February 23rd when we release the actual statements. And subsequent to when the year ended until when we actually released the statements, two things have happened, and they've happened before we actually released the financial statements. The first thing that happened was on January 21st. We went ahead and we issued some stock to the tune of $900,000. The intention of issuing the stock was to pay off this debt. And so that's what we did. When February 2nd came around, we had issued $900,000 worth of stock, so we had the extra cash to pay part of that $1.2 million obligation that was back up in here. And so on February 2nd, we paid off that $1.2 million worth of short-term debt. We used that $900,000, plus we took some proceeds from our existing cash of $300,000. So now here's the question. Since we paid them off according to the due date, but prior to the release of the financial statements, can we then go back to here and change what should be current versus what should be long-term? And to understand that, we have to go to the rules we learned about the FASB, what FASB says, and they tell us that this is what has to happen. If a company meets both of the following conditions, then they'll do something different from what we just described. First off, it has to intend to refinance the obligation. They did that. The $1.2 million, they intended to refinance some of it with equity securities. And then secondly, they also have to have an ability to consummate the refinancing. In other words, they can't just say, yeah, I'm going to do it, and then not have the ability to do it. And to be able to demonstrate they have the ability, they have to meet one of two things. They have to actually refinance before the release of the financial statements, or they have to enter into a financing agreement. So either one of those would indicate an ability to demonstrate that you will be refinancing. So if we go back here, this is what's going to happen. We're going to take and split up some of this $1.2 million. Some of it will be current, some of it will be long-term, because we've had the intent. Right here proves the intent, and we had the ability because we actually did it. So when we're issuing stock, it also indicates that we have the ability to refinance. Refinancing doesn't only mean converting into a long-term loan. We just happen to refinance it through debt. So here's what maybe this would look like if I actually created the financial statements. So I would properly head the balance sheet. It's kind of an ugly looking balance sheet, but it'll work. It'd have the name of the company, the name of the statement, and then the date, 2012. It would have all my assets over here. I'd have a total assets number, and then the current liabilities, which is the section that is in question. Notice I've got some current liabilities. The amount that I'm going to have that are current liabilities are actually $300,000. And then I'm going to classify under the long-term debt $900,000, and I'm going to have a reference to a note so that the people within the users of the financial statement know what's going on. Look what I named the long-term debt. I said notes payable refinanced in February of 2013, and they're looking at this and saying, well, it's 2012. Oh yeah, okay. I've got to look at the note and see something happened here. And the reason that we take and put the $300,000 in current liabilities is because that we didn't refinance. We took existing assets and just moved them over here. So to classify them as anything other than a current liability does not meet the definition. So my note that I should have corresponding to this balance sheet should look something like this. It should tell the user exactly what happened. We had short-term debt that was refinanced, and as of December 31st, the company had notes payable totaling $1.2 million due on February 2nd, and they were refinanced on their due date to the extent of $900,000, which was received in the issuance of common stock, and then the balance was liquidated using current assets. That's it.